Hey everyone, today we'll be going through the main exam for Tax219, which was the September 2019 exam. So question 1. So straight away that I can see it's an income tax rec question, and you'll find that as we go through these exams, almost every exam has a tax rec question. So what I like to do is just skip to the end. First of all, before I read all the detail of the question, just figure out what exactly it is that we need to do. So in this, we need to do a tax rec by calculating the net income by reconciling from accounting profit to net income, calculating the correct tax adjustments in respect of 1 to 14. Okay, and then the next step is to calculate Harry's taxable income for the year end 30 June 2019. So ordinarily you'll get a question where it just says calculate the taxable income. You start from accounting profit, you get to taxable income. In this question, the reason it's phrased a little bit different is because it's actually a partnership, which means it's going to be a little bit more complicated than it would be for a normal question. In a normal question, for us a general tax rec, what we can do is just every time we have a particular adjustment, we can just look up how it's treated in the tax rec guide, which is in the tax critical file notes that you can download from our website. However, because this is a slightly unique and different question, we actually have to refer to the critical guide for partnerships, so we can actually tick off how each of the items are treated under a partnership. So we can go over here and we can cross-reference all of our items over here in terms of how you actually calculate it for a partnership. Okay, so the first one that we're going to go through is professional services income. So what we want to consider is whether it's going to be on a cash or accruals basis. So if you remember from one of the earlier chapters in the critical file, we talked about the fact that large companies have to be on accruals basis. And what that means is it doesn't matter when the cash is paid for the invoice, it really depends on when the work is done. So we can see that they've issued $5 million here as revenue, and we just want to make sure that there's no revenue in here that relates to a different period, which means that we need to adjust that. It doesn't matter if cash has been paid in a different period, it's when the work is done. So let's have a look. So it includes invoices totaling $220,000 which were issued and remained outstanding. That's fine, so they can be outstanding. As I said, it doesn't matter when it's paid, which is what it means when it says outstanding. It excludes invoices totaling $100,000 which were issued in the income year 30 June 2018 and received during the income year ended 30 June 2019. Again, this doesn't matter because that's just talking about when the cash is received. We only care about when the work was issued. So that's correct. So in this case, you wouldn't actually make any adjustments because that's been done correctly. So let's move on to our... So this is how I want you to set up your response when you get a tax rec question. So we start off with our accounting profit. So our accounting profit you can get from down the bottom. Accounting profit here, 4631. And then what I want you to do is list out all of the adjusting items. I know that's too many, we can delete them as we go. And then what we're going to do is we're going to actually have the item, the tax adjustment amount, which I'm going to put in this column over here. So I'm going to go 0 here because there's no adjustment, and then the reference. Now for reference, unfortunately for the tax module, you actually do need to know the relative reference in the Income Tax Act or relevant act. Fortunately, when we go through this tax rec guide, you can see in this right hand column that there's a relevant reference from the relevant act for thousands of different adjustments in here. If you're not sure, if you can't find what it relates to, there's two ones that you can always rely on. So section 6-5 for revenue, that's like a general one of the Income Tax Act 1997, Income Tax Act 1997. Or if it's a deduction, go section 8-1, Income Tax Act 1997. So these ones you can always rely on. Of course, if there is a more specific reference, you should always rely on the more specific one. And sometimes you can lose a mark if they are expecting you to put the more specific reference. But if you're not sure, always fall back to section 6-5 for revenue or section 8-1. That's only if you're not sure what else you should be using. But in this case, for professional services revenue, just because we're talking about general revenue, cash versus accounting, we're actually going to rely on that general one. Okay, the next one is work in progress, WIP. Okay, so for what we're going to do for this one is we're going to look up our tax rec document that I referred to. Scroll down the end till you get to WIP, work in progress. And you'll notice here that section 25-9 allows the deduction that you pay for WIP. So that's for deductibility, sorry, wrong one. Work in progress, this is for revenue. So it's assessable when the WIP is billed to the client, not derived when in WIP. And you can see here the reference is section 6-5 as well. So because it says over here in the notes that the work to date for clients has not been invoiced, it means this isn't actually revenue and we need to actually adjust it out. So when I say it's not revenue, I mean it's not recognized for tax purposes as revenue, but it might be recognized for accounting purposes. So that's why we're adjusting it for tax only. So what we're going to do is we're going to adjust out the 550,000 and we're going to copy this reference here, section 6-5. Okay, so what's the next one? Distribution from a property unit trust. Okay, so for the next one, a property trust distribution. So when you think of that, there's a few things to look out for. Because it is a unit trust, there could potentially be a capital gains event where the cost base is below zero. The other thing to look out for is that we need to include only the tax or the portion of tax profit of the trust, not the accounting profit of the trust. If you need more explanation on that, watch our videos on trusts. But basically what we need to do is we need to look at what's the taxable income. So the taxable income of the trust is a loss of $10,000. So basically he would only actually record in his taxable income 10% of whatever the tax loss is, of the tax profit is. So in this case he's actually getting a negative $1,000. Okay, but trust isn't like a partnership, so the losses aren't actually distributed to the beneficiaries. If it was a partnership, that would be the case, but at trust, losses are accumulated in the trust itself. So all we would have to do is just reverse out that $2,000 there. So you can see trust income. I'm just going to reverse that out, and you can see that it's actually referenced in here as well. So it's also saying watch out for where the cost base is less than zero, and also look out for timing differences in trust income accounting versus tax. So use tax, and then there's our reference there. Notice how that's a more specific one rather than the section 6-5. It's always better to use the more specific one, because sometimes you can potentially lose marks from the marker if there is a more specific reference that you should be using. Okay, interest income. So straight away I'm going to search for interest income in my notes. Here it is. So interest income is assessable when received or credited. So unless you're in the business of money lending, according to the My Emporium case, interest is derived on a receipts basis. So basically when you receive the money. Okay, so when is that? So for on 1 July, the principal, along with $10,000, was reinvested, which matured on to 1 September 2019. So in terms of timing, the accrued interest is constructively received on the date it is reinvested. So constructively received means basically when you give the bank instructions. So in terms of timing, this is the only trick to this question, is because if the interest was deemed to be received on 1 September, then we'd have to reverse out this entire amount. But if it was deemed to have been received on the 1 June, then this is correct. Now, because the principal gave instructions on 1 of June, therefore the interest has been constructively received on this date, and therefore that is the correct amount to be including there. So for interest income, the adjustment is 0, and the reference is section 6-54. Don't forget the act as well. I'm not going to write it here, but don't forget to write in the exam Income Tax Act 1997 after you write that as well. Okay, gain on sale of vacant land of $40,000. Okay, so it's easy to forget that this is a unique question and we're actually dealing with a partnership. So don't forget, so that's the important thing in an exam, because you're going to be under pressure. You're going to be working hard. You might think up here, yep, okay, it's a partnership question. I need to remember that, and then you start going through the tax rec questions and you start doing it for a muscle memory. But you also need to remember, is there anything I'm missing in this question? Were there any special bits about this question? So you always need to have that at the back of your mind, especially under pressure. So if you didn't, you would forget that we're dealing with a partnership question, and this is a particular nuance of this, because if you remember from our partnership videos, in the core content, is that certain elements of a partnership are assessed at the partner level, not at the partnership level. And what that means is they're actually reversed out of the income of the partnership. So, for example, capital gains is one example of that. So capital gains are losses, prior year partnership losses, personal super contributions, salaries and drawings to partners, and interest payments on partners' capital accounts. So just watch out for all of these things. I probably should have said that at the beginning of the video. But yeah, we obviously saw that it was a partnership question. So we need to immediately think, okay, what are the nuances or the unique things about partnerships that we need to remember as we go through it? So because of that, this is a capital gain, and we're going to have to actually reverse that out because of what's in here. So here we go here, section 6-105. So we can copy that. And we can put this in our exam here. We're going to reverse out the capital gain. Okay, so next one is lease incentive. So straight away, what I've done is I've did a Control F in the tax rec guide, and I found this. Now, of course, in the exam, you're not going to have a Control F feature. So what I recommend, as you go through these videos, as you practice your exam papers, print out your critical notes, print out your tax rec guide, and start tabulating. Put tabs in there so you can identify areas that you've used before, and then get faster at flicking to them quickly. Because part of the exam is just moving through it super fast. Because you can be really, really smart, you can know all the content, but if you can't finish the exam in time, you're going to lose marks. So you've got to get really fast at this. Okay, anyway, lease incentives over here, we can say that this is income if in the ordinary course of income, and this is a non-cash benefit, section 21A. However, what we've got here is a specific trick in here, the rent-free period, which is interestingly the same thing that we're talking about over here in the exam. It's not assessable, as it would be considered a non-cash benefit, yep, section 21A, but this isn't assessable if it's deductible if it had been incurred. And because it's rent, it would be deductible if it had been incurred, so therefore it's not assessable under section 21A. See how good are these tax rec notes? They've got all the little tricks and everything in there. All you need to do is find it, apply it, and there you've got your full marks. So what we're going to do is we're going to reverse this out. How much was it again? 100,000 minus 100,000, and our reference is right over there, section 21A. Okay, so the next one is salary. So again, as soon as I saw salary, I'm thinking, okay, that was one of the things in the partnership list that we had open. So salaries and drawings paid to partners. So already I'm thinking, okay, they're probably going to try and trick us by including a salary there for one of the partners. So it includes salaries of $200,000 paid to the partners, $120,000 and $80,000 to George. So as we correctly identified over here, we can remove these salaries minus 200,000, and then our reference is actually this case here. And you could also potentially reference the tax ruling here as well. Cool. Easy. Employee benefits expense. So I've got accrued employee entitlements of $35,000 for leave that has not yet been taken by employees. So the first response is to look up our employee entitlements. So employee benefits expense, employee entitlements of 35K. So it includes an amount within that 100K that has not yet been taken by the employees, okay? So if we look up annual leave, we will see deductible when paid. Accrued leave is not deductible. Okay, so it must have been paid. And we're saying in this question that of that 100K, 35K has not been actually taken and therefore paid, which means that 65K has. So we're going to have to reverse out this 35K in accordance with section 26-10 and the flood case. Okay, while you're just typing this out, as a sense check, just make sure that your number that you're typing in, because we're roughly halfway, actually reconciles with a number over here, so that you actually haven't missed one or double counted one and so forth. So just keep that in mind as you're doing the exam. Provision for employee bonus. Okay, so estimate of bonuses to be paid to employees. Okay, so they haven't actually paid it yet, and they're planning to pay it in August 2019. Okay, so as we can see that bonuses are derived when paid, same as salary. So this is actually the revenue component of that, but it's the same for payouts as well. So it's only deductible when it's actually been paid. So we'd have to reverse out the entire $84,000 there. The reason is it's still subject to the partner's discretion, so obviously hasn't been paid yet. So minus 84,000. Okay, so just while we're going through this, I just want to make sure that we're using the signs the right way. So because we're doing tax adjustments, any income we've written in here, we need to reverse it out if it's not deductible. Likewise, if there's any deduction, we need to do the opposite of that. We need to actually add it back. So I just realized we actually need to increase our accounting profit because we're reversing out an expense. So an expense brings down our profit, and taking out an expense brings it up. So what we need to do is actually make sure that we're putting these the right way. And I just realized as well that I put in, instead of the 35,000, I put the 65,000. So again, another reason why you should be always going back and just double checking what you're doing. So thinking logically, just taking a step midway, just think, have I done this the right way? Are my numbers around the right way? Have I got the positives and negatives right? And just do a quick sense check. That's how I picked up that I accidentally wrote 65,000 instead of 35,000 as we discussed. So, and this one's going to be positive 84,000 because we're reversing. And I'm just going to put the general deduction one in there, section 8-1 for that one. And just lining up the numbers, so 9 aligns with 9, so we're all good, and we can keep going. So interest expense. Okay, so first thing I'm going to do is just bring up interest deduction on here. You can also just scroll down until you hit I. That should get you in a reasonably good place. So we've got interest income, and we've got interest outlay as well. So there's quite a lot on interest. It can be quite a difficult topic. So the other thing that we just got to keep checking back to is, because of that little nuance of the question being a partnership, have we considered everything here? Now, I do remember that there was something about interest in here. Interest payments on partner's capital account rather than loan account are not well, we have to exclude these at the partnership level. So most likely they're going to try and slip in something like this in the question, so that we actually have to adjust for that. So let's have a look. Interest expense here. Okay, so interest was paid on a $400,000 loan borrowed from the bank. The loan was taken out and used to refinance $400,000. Up here we go. Straight away, I can see they're linking it into this. So it was borrowed to refinance $400,000 of capital. The capital withdrawn was distributed equally to Harry and George. The partners used their distributions to acquire various investments generating accessible income, debited to partner capital accounts in the amount of $320,000, and business revaluation goodwill in the amount of $880,000. Okay, so I can see that there's really two purposes being used for the interest, and this is really what we need to consider in determining whether interest is deductible or not, is what is the purpose of the funds. So in the partnership chapter, we went through a few different scenarios about what is deductible, what's not deductible for interest. So the two scenarios that we have here is, number one is this one here, the refinancing principle. So interest payable on borrowings to fund a repayment of monies originally invested by partners is deductible. So I can see that interest paid on the $400 was used to refinance $400. So that's what's happening here. Debited to the amount. So we can see that of that loan that they took out, the $400,000, only $320,000 was actually used to repay the partners' capital accounts, which is this one here, and $80,000 of it was used to effectively pay down this business revaluation of goodwill. Okay, so what that means is we can only deduct the portion that of the $400,000, the debt, was used and debited against the capital accounts as opposed to goodwill. Okay, the reason is that down here it says interest on borrowings used to replace capital internally generated from the revaluation of assets not yet realized, e.g. land, goodwill, or revaluation reserve, is not deductible. So what that means is we need to apportion the $30,000 interest expense, and we can only deduct the $320,000 portion and not the $80,000 portion. And the case that we can actually reference is the refinancing principle, so FCT versus Robertson Smith. So let me just copy that in, and the calculation will be equal 123 times 320 over 400, 24. So is that right? So that means, so that's not right. It means that of that, this is the deductible portion. So this is why it's important to think logically after you do the question and not just blindly follow the formulas. That's the deductible portion, which means we need to add back 6,000, which is 30 minus 24. So 6,000, which is the 80 over the 400 times the 30. Okay, that was a tricky one. Okay, next one, prepaid professional indemnity insurance. So I'm going to look up prepayment. Okay, so we've got a lot of rules around here. So a prepayment is when you actually pay cash up front for something that relates to a future period. So we can see in this exam question they paid at 30 June for the next 6 months from July to December, but because that falls outside the financial year, it's actually prepayment. So there's certain types of entities that actually can claim that deduction up front, but because most large companies and businesses are on accruals basis, you can't actually deduct it unless you can actually claim one of these exceptions. So the exceptions are, per this rec question, is that if it's lower than $1,000, that's not the case here. If it's for wages and salaries, that's not the case here. or if any of these reasons up here. So small businesses get an eligible one as well, but that's not the case here. So unfortunately what that means is we actually need to put in the entire amount. So we've got a deduction in here which we can't claim. So we're going to have to increase this because it doesn't satisfy any of the exception criteria, and it's an upfront payment in relation to a future period. And think about it like on an accruals basis, we can't deduct it if it doesn't relate to the period that we're being assessed on. So we need to add back the entire amount, and the section reference that we will use, section 82 KZL. Just like that, super easy. Okay, professional costs. So we've got $15,000 legal and accounting expenditure in seeking advice unrelated to tax to convert the partnership to a company structure in order to limit professional liability. Okay, so whenever you see legal costs, your first thought should be, is this expensed or is this capitalized? And if it's capitalized, can I get a black hole deduction? So black hole deduction is basically, even if it's even if it's deductible, if it falls under a certain category, then you actually have to apportion it over a number of years. So here it is here, black hole expenses. If you actually look up legal fees in this document, it'll redirect you up here to black hole expenses. So this is basically anything to do with setting up a new business structure, converting, raising equity, defending as takeover. So basically the capital structure of the business. It's not deductible. It's upfront. It's deductible over 5 years under black hole, which is section 40-40. So what that means is we need to add back the entire deduction of $15,000, but they are allowed a deduction for over 5 years. So actually it's going to be 15,000 minus 3,000, so it's going to be 12,000. We're going to add back 12,000. So they're only going to get a deduction of 3,000 if we add back 12,000. Does that make sense? Oh, and our section reference is section 40-880. Cool. And then entertainment expenses. So whenever you see entertainment expenses, you should be thinking, okay, is this FBT? So, or alternatively, you could just look up entertainment in the tax rate guide, and you'll see that they are not deductible unless they were incurred in providing a fringe benefit. They'll be deductible, but you need to be able to have actually paid FBT on it. Okay, so let's have a look. So the costs incurred to entertain clients at various restaurants, of the total cost, 40% to Harry and George, and 60% relates to clients. Okay, so this is actually a trick question because the wording of the question suggests that they've actually paid FBT on this, but that's not what it's saying. It's just saying that CAP uses the actual expenditure method. They're not saying it, they're talking about for these guys, because first of all, are they employees? Okay, this is a really deep trick question, because if you look over here to my right screen, you'll see that under Ellis versus Joseph Ellis, partners are not employees. And we also know from the FBT videos that FBT is only payable for employees. Now, if these guys can't be employees, then FBT could not have been paid, and therefore there is no deduction. Damn, that is a trick question. That is a really good question. But I'm sure some people would have been angry when they saw this and thought that meant that they've paid FBT on behalf of these guys. But again, you got to know your content. So if you have time, make sure you watch all of our core videos on tax, so that whilst yes, they're very long and boring at times, you wouldn't be able to get this if you haven't seen this type of question before, because you need to know the content to be able to answer that. Granted, it's not worth a lot of marks, but you know, if you have time, do go and watch all of those videos. Okay, so we need to add back the entire 52,000, and we can reference that case over here that partners are not employees, as well as I don't know, section 32-5. Actually, that's probably all we need. And doubtful debt expense. Paste that in there. Okay, 30% of this amount was written off as bad debts. So let's bring this up. Bad debt. Okay, deductible when written off. So only 30% of them have been written off. That means we need to add back 70% of this amount here. So we need to go equals 70% times 50,000. There we go, 35,000. And the reference is this one. Should be fine. Cool, and that is it for the first 14 questions. Okay, so the only remaining step is to actually calculate the taxable income. So all we've got to do now is just sum up all of these to calculate taxable income. Equals sum that 4453. Okay, and then let's just double check again that we've covered up everything in the question so we get the full marks. There's nothing worse than losing a couple of marks because of a sloppy error. So calculate net income, tax adjustments, provide a case reference. So we've got case references for everything. An explanation for item 10. Oh, we missed this one. Item 10. Okay, right. So we actually need an explanation to get full marks. This is why it's really important to read the question and give the marker exactly what they're after. So we mentioned before already what the explanation was, and we'll put in the calculation as well. It's because of the deductibility. Where is it? Here it is. Here it's because of the refinancing principle, and it's, you know, and I'd quote Roberts versus FCT, and then give a calculation as to how we calculated the amount. So apportioning this over here, so the 80k versus the 400k, and saying it's only deductible to the extent that it's a repayment of partners' original capital, and any amount that is used to replace capital internally is non-deductible. Okay, so that's all you should need to get full marks there. So just do another quick reference and the most relevant section reference for that. Okay, perfect. So that's 17 marks, easy peasy. All right, next one is calculate Harry's taxable income for the income tax year 30 June 2019. Okay, so this is Harry's obviously one of the partners in it. So again, we need to think about, because it's a partnership question, how do we actually calculate it, amounts at the partner level. So the key ones that we're going to adjust for is going to be capital gains. Also any salary paid to partners, and so forth. So here it is here. So interest income in respect of loans to partnership, partners, personal civic ownership, priority losses, capital gains or losses. So that's pretty much it. Okay, so how we're going to answer this question is just first of all refer back to our critical file and make a list of all the adjustments that we need to make at the partner level. So first of all, we start off with the net income or loss of the partnership. Okay, so we've got the net income of the partnership, but what we have to do is we also have to adjust for a few things. So number one is partner salary. And that's really it. So we need to remove partner salary from here. So first of all, our taxable income, this is question 2, or I should say net income. So our net income is this. Is there a salary? Is there a salary paid in this question? So yes, there is. Here, salaries paid $200,000 to the partners. So we need to minus 200. So after we remove the partnership salary, we can say share of partnership net income. Oops, sorry. Okay, so do they have, what's their percentage each? The equal entitlements. So divide by 2, so they're each going to get 2126. Okay, and then who are we calculating? We're carrying Harry, so we need to add back Harry's salary, which we saw was up here of $120,000. Yep. And then what else do we need to do? Okay, and then let's just do a quick check off. We've covered everything. So we've split the share of equity. We've added back the partnership salary and then distributed that 50-50 according to their entitlements. So step 2 is to also add in certain amounts and deductions at the partner level. So number 1 is interest, income, expense, and restrictive loans to partnership. So let's just quickly check, is there any amounts in there? There doesn't appear to be, because the only loan is borrowed from the bank, not from one of the partners. And I haven't seen it anywhere else in the question, so I think we're good on that one. I think we can cross off that one. What else is there? So there's partners, personal super. I didn't see that in this question either. Let's just do a quick skim to make sure that we haven't missed it by accident. Okay, no, I don't think we have. And then prior year losses carried forward, I didn't see that either. And then capital gains is a loss. I did see one before from here, the gain on sale of vacant land, $40,000. Okay, now we can actually work out the net capital gain here, because if you remember from the modules that partnerships also get access to the CGT discount, but it's assessed at the partner level. So the capital gain would be 490 minus 300, so it'd be 190,000. Okay, and then that gain is split between the two partners. So it'll be so 190,000. If I did the math over here, so capital gain is 490 minus 300. Okay, 490. Okay, so 190. And then because we've held it for 12 months, greater than 12 months, we get the CGT discount. So divide that by 2, and then on top of that, that's the total between both the partners. So if we divide it by 2 again, this would just be Harry's share. So that should be our answer here. So Harry's taxable income is equal to the sum of all of these, and that should be your answer. So you can see where the marks come from for this question. 3 marks, probably 1 mark for the correct answer, and then probably 3 marks, 1, 2, 1, 2. Well, it's not quite clear how they allocate the marks, but you need to go through all of these steps to get the full 3 marks. So there we have it. We received a full 20 marks on this question, 100%. Okay, so the next question. Now, I haven't read through this